Good morning, everyone, and welcome to our Grain Market Outlook webinar for 2024. My name's David Eudall. I'm the Economics and Analysis Director at AHDB, and it is my pleasure to introduce you to this webinar this morning. In terms of the content that we have for today, we're going to be looking at domestic supply and demand situation first up, and then looking at the global grain market, followed by a review of how SFI is potentially impacting our cropping areas and if there is any impact on food production. We'll then go through a Q&A section at the end, and realistically, that's probably going to take us to about somewhere between 11:30 and 12 o'clock for us to wrap up, depending on how many questions that you have. In terms of housekeeping for the webinar today, all attendees will be muted. This webinar is being recorded and will be made available after the event. And as ever, we have a survey for feedback at the end of this webinar. So please do help us improve everything we do in the future by completing that survey and giving us your feedback. Importantly, we have the function to ask a question. In order to do that, we have a question box on the top right-hand side of the screen. So if you just open that and then type in your question to submit, that will come through. Feel free to type in your questions as we go through the presentations. I'll be keeping a log of those. And if there's any which are sort of all grouped in on a similar subject, I might sort of group the questions together into one to try and cover them off in one go. But we will be having those questions at the end of the session. I'm actually going to ask if Olivia, if you can join, Olivia, and we can attempt to see if we can get the domestic side of the market situation up, and then we'll see if we can get Helen's slides fixed. So let's go with Plan B, and we'll see if we can get the domestic side. So Olivia, if it's okay to hand over to you, shall we get the domestic side of the grain market discussed first up?
Yeah, I'll give it a go. Just let me know whether you can see them or not. Can you see those there, or is it the same?
I think
same
we've
issue
got the
again.
same issue that they're going through on the.
Is that working?
There we go. You are on and up and running. So Olivia, I will leave you to it. Thank you very much.
Perfect, thank you. Yeah, so I'm Olivia. I work in the market intelligence team, and I'm just going to go through the sort of domestic side of things. So talking about domestic supply and demand, and then also having a quick look at some longer term trends in terms of domestic demand and what that might mean for us as we sort of progress through this season and also over the coming seasons as well. So I'm going to start off by talking about the supply side of things. So if we first of all just sort of cast our minds back to last season, so here I've put together some stocks to use ratios for wheat and barley. So basically we calculate these stocks to use by dividing ending stocks by consumption and exports. And that just gives us a bit of an idea as to how tightly balanced the supply and demand is for that season. So you can see from the graph on the left there that the wheat stocks to use ratio is around 20% last season. So that's compared to just over 12% a year earlier, and a 5-year average of about 12% as well. So significantly higher than what we'd usually expect. So that's sort of down to a few things. So despite an average sized 2023 wheat crop, and domestic consumption being slightly higher than the previous 5-year average, those heavier imports towards the end of the season that we saw because of the concern over harvest 24 saw stocks up 53% on the year. So we ended last season with around 3 million tonnes of wheat stocks. And of course, that's meant that we've entered this season with that higher level. So on the barley side, The stocks to use last season was just over 17%, so that's slightly higher than the previous 5-year average, but relatively in line with the year prior. So even though production was a little below average and consumption was in line with average, much like wheat, because of those heavier imports, we saw slightly larger than average ending stocks, but they were relatively in line with the year before. So we entered this new 24-25 season with just over 1.2 million tons of barley stocks. So that's the stock side. If we then have a quick look at what we've produced from Harvest 24. So as has been well sort of documented and reported, it was obviously a really difficult season last season throughout sort of the planting period and also the establishment of the crop. Specifically for those winter crops, we saw quite an impact in those production numbers. So currently, we've got a provisional estimate from DEFRA for the England area and then a Scottish government figure, and we've carried forward the Northern Irish and Welsh figure to give sort of a UK overview of what we're expecting so far from the 24 crop. So you can see here that we're expecting a 21% decline in production in 2024, and that's also down 20% on the 5-year average and the lowest since 2020, and also the second lowest behind 2020 since at least the turn of the century. For barley, because the majority of the crop is spring, we didn't see quite the same impact of those poorer conditions. So production in 2024 is actually estimated up 3.5% on the year and down about 4% on the 5-year average. And then if we have a quick look at oats and oilseed rape, so oats are estimated up 20.4% on the year, but this has come out of quite a low production year, so actually it's relatively in line with a sort of average sized crop. For oilseed rape, we're expecting the UK crop to be down 33% on the year, and as you can see, that's the third consecutive decline. That's also 35% below the 5-year average and the lowest figure since the 1983-84 season. So that's sort of down to a combination of things. So obviously the poor planting conditions throughout the drilling period, but also those sort of SFI options looking potentially more attractive in terms of managing risk. And my colleague Amandeep's going to go into that in a bit more detail a bit later on. But also just generally issues with being able to produce a viable crop with those sort of pest pressures, insecticide resistance, and so on. So that's the production side. To sort of bring together a final picture of availability this season, we of course need to talk about imports as well. So full season wheat imports at the moment, we are expecting them to reach 2.6 million tonnes. So that would be up about 7% on a year earlier, which was already quite a strong import number, and 40% above the 5-year average. So these would also be the highest imports since at least 2012, 2013. As you can see from the graph, that still brings us quite a bit below that 5-year average in terms of total availability. So those firm imports are still very necessary, even though we've got those higher stocks because of the extent of that production loss. So all in all, total availability of wheat this season, we're expecting it to be down about 6% on average. On the barley side, we're expecting quite minimal imports, so about 80,000 tonnes. So even though we had a marginally smaller crop than average, the heavier stocks mean that we won't be relying on those firm imports as much as we would for wheat. And total availability is estimated just under 8.5 million tonnes, which is back slightly on the average, but up over the last 3 years. So that's sort of the supply side. If we then have a quick look at the quality of the crop and also what that means for premiums at the moment. So generally, wheat characteristics were quite good. We're hearing that protein was quite low, but no sort of problems with Hagberg, and specific weights were quite encouraging in our harvest reports. We do have a cereal quality survey, which the results come out for later this month, which will give us a bit more data and a bit more of an accurate reading as to how much of the crop will sort of meet specification. But these are sort of initial findings from those harvest reports. So generally, wheat crop was probably better than we expected, just that lower protein. And also something to consider is ergot. We're hearing about very high levels of ergot at the moment. And that's, of course, sort of impacting grain intake in some places, sort of slowing down with the process of needing to clean the grain. So on the back of that lower protein, on top of an already smaller crop, um, we're seeing quite firm imports, as I said, 2.6 million tonnes for the full season. And because of that competitively priced wheat coming in, we're seeing those milling wheat premiums ease back slightly. So in September, the ex-farm milling premium over feed averaged just under £48 a tonne. If we were to look back to August, it would be about £57 a tonne. And actually in the same month last season, it was about £60 a tonne. So has eased back slightly, but at the same time, it is historically very high if you look back to sort of 2021, for example. For barley, even though we've heard that nitrogen and screenings were a bit poorer on the year, the functionality generally looks quite good. And we're expecting a big proportion of the crop to meet that sort of malting quality. So due to the functionality and the size of the crop, as well as the steady demand for malting barley, which I'm going to go into in a bit more detail in a couple of slides, the premiums have dropped back on the back of that. So in September, ex-farm malting barley premium averaged about £20 a tonne. If you look back to August, that was about £27 a tonne. And actually, if you look back to June a few months ago, that was £66 a tonne. So that has dropped back quite considerably in that time. So moving on from the quality side of things and on to feed, the gap between feed barley and feed wheat has widened quite a bit over the last 12 months. So in September, that discount of feed barley was just over £26 a tonne. If you think back a year ago, that was about £20 a tonne. So it's widened slightly. And because of that, we're expecting quite minimal wheat usage in feed rations and substituting a bit more barley and also imported maize into that compound feed. So obviously, like I was mentioning about maize imports are quite an important thing to consider this season. They're pricing in quite competitively at the moment into the UK. And so because of that, we're seeing a very firm flow of imports at the moment. So on the right here, you can see imports for July and August. And you can see that we were about 515,000 tonnes compared to the 5-year average of about 375. So quite significantly higher. And we think that the sort of imports of maize will sort of restrict any domestic feed price rises to an extent. Obviously important to point out that Northern Ireland imports quite a lot of feed grain, so a chunk of those maize imports will be going into Northern Ireland, and therefore it might not have the impact that we would expect just from 515,000 tonnes of maize imports, because some of that will be more to do with the Northern Irish market. So that's the supply side. I'm now going to look a little bit into demand for this season. So just to explain this chart, basically the three bars on the left of what I've obviously spoken about, so the availability side of things, and then the three bars on the right basically show how those supplies are used. So we've got human industrial consumption, which includes wheat used for flour milling, wheat used for bioethanol and starch, and also brewing, malting, and distilling as well. And then we've got animal feed, and then that balance is what's left over after those two other factors are taken into account. So if we start off by having a look at the H&I side of things, so we're estimating total H&I usage down almost 4% on the year. but up about 1.5% from the 5-year average. So this yearly decline is largely to do with reduced usage in bioethanol and starch. So as I was talking about that competitively priced maize, in bioethanol production, we're expecting a bit of a shift to maize usage where possible. And also wheat usage by flour millers is expected to decline very slightly. We saw quite a steady start to the season on that side of things. For feed, we're expecting a 9% decline on the year and also down about 7.5% from the 5-year average. So while we're actually expecting some growth in total feed production, the proportion of wheat used is going to be lower due to wheat pricing less competitively against barley and maize. And we also think that the amount of wheat that's fed on farm will come down as well because of that tighter availability and also the higher selling price against other grains. So once we've taken that into account, that leaves us with a balance of just over 2.6 million tonnes. So that's down 23% on the year, and it's the tightest balance since the 2020-2021 season. And once we've taken out just over 1.5 million tonnes of that as an operating stock requirement, so that's the minimum tonnage that users of grain require to get through to a point at which they can then use the new crop. After we've taken that out, we're then left with just over 1 million tonnes for either export or free stock, which is well below the 5-year average. So on the back of that, we would expect exports of wheat this season to be fairly minimal. And in July and August, we saw wheat exports down about 70% on the average pace. So now to have a quick look at barley, we've obviously spoken about how availability is back slightly on the average. And here we can see that consumption is up on the average. And as such, we're left with a slightly tighter balance year on year. So for H&I, to start with, we saw quite a steady start in brewing, malting and distilling, and we're expecting that to continue. So the industry report sort of suggests that the poorer demand is due to a combination of things. So the ongoing high cost of living, fewer young people choosing to consume alcohol, and also maintenance being carried out on a few of the key sites across the industry. So because of that, the H&I forecast is down 4% on the season, and also slightly down on the 5-year average as well. Bit of a different picture for feed though. So barley usage for feed is actually expected to rise 8% on the year and 4% on the 5-year average. So as mentioned on one of the previous slides, because barley is pricing more competitively than wheat, we're expecting to see a rise in usage in rations. So we also think the amount of barley fed on farm is expected to rise on the year. So due to that increased availability and also the lower selling price relative to other domestic grains, we think we'll see more farmers sort of holding on to that barley. So that leaves us with a balance of just over 1.9 million tonnes. So that's down about 17% on the average, and it's also the tightest since 2021, 2022. And for barley, we take out an 800,000 tonne operating stock requirement for that. So that leaves us with just over 1.1 million tonnes for either export or free stock at the end of the season. So that's the sort of domestic supply and demand situation. I'm now going to talk a little bit about longer term demand trends. So first off, if we have a quick look at animal feed, you can see from the graph on the left there that total feed production has edged up slightly over the last sort of 20 years. And the pig sector has actually seen the biggest growth over that period, followed by sheep. We did see, you'll notice, quite a dip in 2022-23. That's specifically for poultry. So as I'm sure you can guess, that's sort of on the back of avian flu and just generally squeezed margins in the industry. And looking ahead, for both cattle and sheep, we've seen quite a contraction in numbers in recent years, and it's probably quite unlikely that we'll see much change to that. I think sort of any stability or improvement in meat production will be due to the improved efficiency rather than herd numbers, which is what's going to impact feed demand more. And we're hearing a bit more about producer numbers in general being pressured by sort of land use changes, specifically in the uplands. So something to keep an eye on. And I've put some other key points on there, but I'm not going to go into this in too much detail. But our market intelligence livestock team are putting out some forecasts up to 2030 in a couple of weeks' time, which I think will give us a bit more idea of what we might expect from those numbers and therefore feed demand in the coming years. So next off, if we talk about flour milling, you can see that again, generally demand has shifted upwards over the last 20 years. Last few years, growth was impacted by those COVID years and also post-COVID sort of cost of living, people choosing to eat out less. However, as wheat flour is a staple in most of our diets, it's quite unlikely that we'll see sort of significant fluctuations from that sort of trend level over the coming years. However, something that does fluctuate a little bit more is the split of homegrown and imported wheat milled. So we see obviously a significantly high proportion of imported in years of small production or poor quality years. So it does seem as though we're getting more dependent on those imports. So in the last 5 years, we've imported more than the sort of 5 years before that, if that makes sense. And again, of course, we're expecting imports to be very heavy this season. So if we see these weather events becoming more extreme, it could become more of the norm that we're importing at a higher level. So for bioethanol, at the moment, we're seeing quite pressured ethanol prices, and that, of course, impacts the margins of the bioethanol plants in the UK. And as such, we tend to see production pull back a bit during those periods. However, looking at ethanol forecasts at the moment, we're expecting some support over the coming months, which could boost production slightly towards the end of the season. However, of course, it's very dependent on that maize wheat price relationship as to how much wheat we see used in that production. The Renewable Energy Directive is also something that we're sort of monitoring at the moment. So our current supply and demand estimates assume the resolution to those requirements after we've left the EU. However, obviously that could change significantly if the status of our domestic wheat changes. So just something to keep an eye on. So just finally, if we talk about brewers, maltsters and distillers, again, you can see that barley usage in that sector has edged up over the last sort of 20 years. There has been some periods of downturns, so that's in line with the recession back in 2008, 2009, and then also COVID in the 2019-2020 period. And we're also hearing that last year and the start of this season, we've seen some downturn again. So as mentioned previously, that's sort of down to less young people drinking, cost of alcohol being very high, and as such, we've seen demand pull back on the back of that. We're also seeing the number of nightclubs, social clubs in decline. So you can see on the right there, this sort of compares the number of openings versus number of closures from December 23 to June 24. And you can see those nightclubs, there's more sort of closing than there are opening at the moment, which isn't helping demand for brewing, malting and distilling. We've also seen a pullback in exports of malt and also Scotch whisky exports. So it is the distilling and malting side as well as the brewing side, which is what I think we were hearing sort of up to last season. So if we continue to see this trend progress longer term, we could eventually see a bit of a pullback in demand for malting barley. And like we're seeing at the moment, we are seeing those premiums sort of pressured on the back of that. So for rapeseed, the graph on the left here shows how the decline in production is outweighing the decline in crush. So this sort of poses the question as to how are we going to fulfill the domestic demand for rapeseed. And then the graph on the right basically shows that from sort of 2010 to 2017, we were actually net exporters of rapeseed. And in 2017, that sort of trade position flipped, and we've now become net importers. In the last few years, particularly, we're very reliant on those imports. And as you can imagine, looking at the 2024 crop, in 2024, we'll be importing quite a lot of rapeseed, even if that crush was to come down slightly. So sort of key takeaways on the demand side, fairly limited growth probably on the animal feed side, still some concerns over the margins. Flour milling we'd expect to remain fairly steady. Bioethanol is more of a sort of watch point in terms of that price relationship and also the Red 2 situation. For BMD, it's likely the impact will be quite minimal short term, but longer term we could see a bit of pressure because of that downturn in demand. And then also for rapeseed, a watch point is sort of how reliant we are on those rapeseed imports. So just as a final point before I hand back to Helen, we just wanted to talk a little bit about what we're sort of doing at AHDB within our team to make sure that our data is being continuously improved and sort of revised. So at the moment, we're looking quite closely into alternative data collection methods, so specifically focusing on newer technologies such as satellite imagery. And we think that'll be quite key in looking at sort of area and production figures and making sure that they're as accurate as possible and we know how much grain we've got in the country. Obviously, also looking at timeliness and accuracy of the data as well. And we also promote the DEFRA surveys in our outputs, just to try and give as big of a sample size as we can to those surveys, again, to improve accuracy, and also reviewing some of our own surveys as well, just to make sure that we're not got any gaps in that data. But I think that is about it for me. I'm going to hand back to David, who will then lead us on to the next section.
Thank you, Olivia. Thank you. Very interesting there, going through the domestic market situation. So we're now going to see if we can go back to the start, and Helen will be joining us again to go through the global market situation. So it's a take two, Helen, and the slides are working now. So hopefully the office Wi-Fi keeps us going.
Brilliant, thank you. So fingers crossed this time. Yana, could you move on one for me? So that's just to say we can't really talk about global markets without looking at our global economic backdrop. And so here what we're doing is the International Monetary Fund, after the shock from the war in Ukraine has eased and inflation has come back to sort of pre-COVID, even to target in some of the G7 members, we do have global economic growth, but it remains relatively weak and back from where we had been in the sort of pre-COVID average. It's worth noting, though, that as we move on, sorry, only half the slides showing up. Can we just pop it all up for me? And then, perfect, thank you. That outside of those more developed economies, inflation does remain higher, and that's a factor for seeing some sort of greater variation in global economic growth levels. Particularly, we think of some of the main importers globally, the likes of China. The economic growth there is expected to decline into next year and is notably below the 5-year average of 7.7%. Not only that, but there are some risks to that economic growth forecast as we look ahead. We can't not talk about the ongoing conflict in Ukraine. And while grain markets have certainly accustomed to operating on that footing, the risk of escalation remains a watch area, as does the situation in the Middle East, where if we did see conflict escalation, there would be likely knock-on implications for crude oil, which would then filter through. The other watch point, which I think particularly comes to the fore more after Tuesday's election result in the US, is around protectionism, with the president-elect during his campaign declaring intentions to increase tariff levels on imports into the States. So those are some quite notable risk areas for this already weak global economic growth level. If we could move on, please, with the slides, and one more into our demand and bring up the chart. Okay, so it's not quite displaying properly, but hopefully you can see the a dark blue line. Nope. Okay, well, I'll talk around it. The point is that for global grain demand in 24-25, we are expecting some growth, but it's a relatively weak growth level of just 0.5%. And with that, so that's on the back of a little bit of food growth in line with population. And then we've got very limited growth from a meat demand perspective globally. And when I'm talking about meat, I'm talking about the three largest here. We're talking the growth in poultry, but that being partly offset by dips back in pig meat and beef demand, meat demand as well. So with relatively weak global ethanol values as well. So although we've got a relatively weak demand, it's still enough to exceed production, particularly for wheat and barley. But in contrast to last year, where we had a notable surplus of maize in the global market, this year supply and demand of maize are expected to be very finely balanced. And that is a sort of a key watch point with some of the major crops in the Southern Hemisphere only just starting to be planted at the moment. Could we move on one, please? So looking at some of those production numbers now, and I think you can see across the EU, Russia and Ukraine, some of those stark pullbacks in both wheat and maize production this year. And that's what sort of tightened the market up, especially compared to what was expected earlier in the year. But as I mentioned, the Southern Hemisphere crops, if we could bring those up for me, are just being maize crops starting to be planted at the moment. Looking at Brazil, the Brazilian supply agency CONAB predicting just under 120 million tonnes, but there are some notable variations. That is quite a lot lower than the 127 million tonnes that the USDA used to make those global projections that I showed you a moment ago. So a sort of key watch area there as well. We've also had some less than ideal weather in parts of Argentina and Australia in the last few weeks or so. So as those crops start to come off, we'll be watching those harvest results. And some private forecasters are indeed lower in terms of wheat production than the numbers that I've got on the screen there. Can we move on one, please? And again, and again. So with that tighter picture, we are looking at a pullback in global wheat stocks. But particularly, it's important to look at the stocks held by major exporters, because these are the stocks that are easily accessible to the market. And it's also important to look at that relative to demand to see how much is there and how much of the global of their export demand would it cover. So that 24-25 wheat export stock figure for the end of the season at 13.5% would be the lowest since 2007-8, and a notable fall year on year as well. It is tempting to look back and say, well, a year ago, the 23-24 crop was only projected to be to pull stocks down to just over 13%. So why pay so much attention to this number now? But I would argue this is actually more relevant because a year ago, although we had a tight market, it was against a backdrop of rising Russian wheat crop estimates, whereas this year we've seen a trend of reducing crop estimates as harvest has progressed and the extent of weather issues has come to the fore. But that said, the location of these stocks will also be important. At the moment, I think there is less attention being paid to that percentage because a large proportion of stocks are being held in the States. And historically, at least, the US has always had a very strong reputation as being very accessible and always open to free trade. So those stocks tend to weigh heavier on the market than those held in other locations. So we'll need to watch not only export paces for key exporters as we go forward to find out where will those stocks actually be held, but also the trade policies. Are the stocks as accessible as hoped in those various countries? I'm thinking here of the Russian export restrictions as well as any potential changes that could come forward in 2025. Next slide, please. So where does that leave us in terms of prices? Well, global wheat prices, I've got US prices here and French prices in the green, are broadly similar to where they were 12 months ago, despite the sort of tightness in the global markets. And at the moment, some of that pressure is coming from the rapid pace of Black Sea exports. So we'll just need to watch that and see how that unfolds. It's worth noting that UK prices are around £10 per tonne lower than last year because of the strength in the pound against both the euro and dollar. If we could add the extra couple of animations, please. So the dark blue line shows is indicative of sort of higher protein content. So and showing a bit of decrease in the global market there, which could bring some pressure forward to us from a UK perspective, though it's important to note there is quite a lot of variation across the world. The other thing I wanted to highlight here was the red line, which shows maize, and then the yellow line showing a sort of global barley perspective. And while wheat's opened up a bigger gap over maize, it's condensed its gap over barley. So I think there's some potential for those demand forecasts from a global perspective to have some variation in the weeks and months ahead. Okay, next slide, please. Just before we wrap up on grains, one of the factors that's been influencing our market recently has been some early crop concerns for 2025 wheat crops. Moving across left to right, we've had higher than usual rainfall in some of the key producing parts of Europe and closer to home as well, which has been challenging planting. Whereas in the States and in parts of Russia and Ukraine, there's been much drier than usual conditions, which has been hampering early crop development. While weather has shifted over the last week or so and has really kind of softened those concerns, planting progress has improved in Europe and Russia, there is still a less than ideal start for crops, and that means markets are going to be a bit more sensitive and nervy of those reports that come forward as we look ahead. And it's going to be an important area to monitor because the poorer start, the more vulnerable to adverse winter weather conditions those crops will be as well. Next slide, please. So just wrapping up here, the global market is in deficit, although we do have quite lackluster global grain demand with an increased reliance on Southern Hemisphere crops. If I was to pick out some key watch points, I think that global demand aspect is one that is going to be quite important to keep an eye on, given the risks and the sort of to the economic outlook that exists there. But the potential supportive factors are around major exporters' export pace as Black Sea grain flow slows down as we move towards 2025, as it happens seasonally, and then watching those new crop concerns. If something happened there, I think we could see an upward reaction, but it's quite a finely balanced situation. Okay, let's move on to look at oilseeds now. And one more, please. So in terms of oilseeds, we've got lower oilseed rape crops and sunflower seed crops for most of the major Northern Hemisphere producers and exporters, really following adverse weather, particularly in the EU and Ukraine in late summer, really crimping those yields back as well for sunflower seed, which added quite a late shock to the market. But at the moment, there is some counterbalancing going on with what's happening in the Southern Hemisphere. In Argentina, very dry at planting, but they've recently had some rain and that has supported development and moved planting on quite notably. One watch area is they still need more rain in the southern areas around Buenos Aires. So just got to keep an eye on that figure. From an Australian point of view, harvest now underway, but it's worth noting that that estimate from the Australian government was made in September and is a more optimistic compared to quite a few of the private forecasters. Indeed, we've got Rabobank at 4.7 million tonnes. So depending on what comes off with the harvest, there is potential for this sort of supply of rapeseed and sunflower seed to tighten even further. Next, let's move on. There's also support from the palm oil market as well. Following lower production in Indonesia through the first sort of 7 months of the season, stocks in Malaysia and Indonesia, the world's two biggest producers and exporters, have fallen back notably. And I'm looking at the dark blue line there at the bottom of that chart. There has been some uptick in production in August, but there's still a lot of nerves, and those nerves are part of the reason we saw palm oil prices move to a 2-year high just last week, 2.5-year high even. Could you bring up the other bits for me, please? Why is this production? Production is expected to carry on recovering through to the end of 2024 and into 25, but it's needed because Indonesia will be increasing its demand for palm oil by increasing the amount of palm oil-based biodiesel blended into transport fuels up to 40%, which Oil World estimates could add around 1.5 to 1.7 million tonnes of extra demand for palm oil per year. The other watch area there is around what happens with crude oil. The higher crude oil prices rise, the more attractive it is to use more biodiesel in road transport fuels, where mandates and technological factors allow. So it's just something to keep an eye on in the background as to what could happen going next. Let's move on. As a result of this tightness, we've seen prices for rapeseed and sunflower seed rise quite notably over the past year in the global market. But I would argue that some of that has been held back by a fall in soybean prices in the dark blue. And that reflects the quite ample expected supply of soybeans this season. Next slide, please. Soybean production in the blue line is expected to rise really quite notably this year due to expanded areas and positive yield prospects in the States as well. So we've had an 11 million tonne rise in production of soybeans in the United States, with harvest now into the closing stages. But South America is expected to increase its production by a further 19 million tonnes as well. And these are the crops that have just been planted. So while we've got a rise in demand, most of that is coming from increased crushing of soybeans in order to try and produce some more vegetable oils to help make up for the lack coming from rapeseed, sunflower seed and palm oil. We're still looking at quite a notable rise in soybean stocks. That's it. Let's move on now. And just before I wrap up then, I wanted to have a quick look at 2025. So from a soybeans perspective, US farmers will soon start to be thinking, or will be already thinking about their planting decisions for next spring. And the relationship between soybean and maize prices is one of the key factors that is part of that decision. And soybean prices have weakened relative to maize over the past few weeks, and they're certainly notably lower than where they were this time last year. So it raises the prospect of, could we see a pullback in the US soybean area for harvest 2025? If we did see that, my view is that it would likely only reduce the pressure on soybean markets rather than lead to, say, a reversal, just because of how high those stocks are expected to be. But that is assuming the stocks actually make it into the barn. So we need to be watching those Southern Hemisphere crops again. From a rapeseed perspective, Quite often after a poor cropping year, you see a rebound in production and a rebound in coming forward. I'm not quite convinced that we'll see that much of a rapeseed, global rapeseed production recovery next year. Couple of reasons for this. Firstly, that following the dry weather at planting, Ukraine's area is down by between 10 and 20%. The government estimating a 10% fall, private estimators down as much as 20%. And with crops in poorer condition going into the winter as well, that I think, unless we see above average yields, would mean production at similar or even lower levels than this year. Meanwhile, we've had a mixed start for EU crops and some early mixed reads on what is happening to the European rapeseed areas as well. Plus, when we look ahead to new crop, with the threat of anti-dumping duties hanging over the Canadian rapeseed market, new crop prices are both at a discount to old crop prices and lower than prices for the 24 harvest were at this point last year. So unless that situation changes, it raises a question about will the incentive to plant rapeseed be reduced in Canada as well. That's going to put more, if that did happen, it would put more focus on sunflower seed crops to perform, I guess, to maintain those supplies. And final slide, please. So pulling that together, looking at the takeaways from an oilseeds point of view, we currently have quite a supported market being driven by the tightness and the price growth in vegetable oil markets. There's a couple of watch points as we go ahead. It's going to be particularly around that palm oil production side and what could happen there. And then watching closely those southern hemisphere crops, particularly the Brazilian and Argentinian soybean crops, but also the Australian rapeseed crops, as to if they come in above or below expectations. And then finally, we'll be needing to watch things into 2025 for a longer term view as well. Thank you. Do you want me to hand David?
Thank you, Helen. Thank you so much for that. I'm glad that the technology worked and everything kept going through there. So that was useful. Thank you so much for taking us through the global side of things. We're now going to hand over to my colleague Amandeep, who's going to give us a review of the Sustainable Farming Incentive and what that potentially means for cropped area and food production going forwards. So Amandeep, I will hand over to you. Thank you.
Thank you. Good morning, everyone. Hopefully everything's working okay and you can hear me. So the aim of the Sustainable Farming Incentive, the SFI, is to produce food in an environmentally friendly manner and encourage farmers or reward farmers for employing sustainable farming practices. Nevertheless, there have been concerns that the SFI will take land out of food production, with farmers signing up to this scheme as direct payments continue to be phased out. But what we're going to look at is how valid are these concerns and how much land can we expect to be removed from food production. Today, I'm going to take you through the analysis and the evidence that will give you a good indication. First of all, I'll start at the farm level and then we'll have a look at the national scale. Okay, just waiting. Hopefully my slide will change soon. Right. So at the farm level, our analysis uses the AHDB virtual farms, which are farms on a spreadsheet, but they are designed to be typical farms that farmers can relate to. The arable farm shown in there in green is the one that I've used for the analysis that I'm presenting today. In the current SFI expanded offer, there are just over 100 actions that are available for farmers to choose from, with a considerable amount of those being borrowed from Countryside Stewardship mid-tier. We've looked at how we can combine or stack those different actions together that are suited to arable land on the 455 hectare arable virtual farm. We've taken two approaches. The first is option A, which is a combination of actions which don't require land to be taken out of production, and they don't really interfere with the setup of the farm. And you can see here they're mainly, the soil assessments, nutrient management plan, integrated pest management plan, cover crops which can fit within the rotation, and also a companion crop which we can grow alongside rapeseed, which is already present on the farm. The payment rates here are shown on the table, but what we've done is we've calculated the net payment that you would get after you factor in the costs involved in these actions. And we've got further details available on the stacking analysis section of the AHDB website. What we're going to do now is look at how much income the farm can receive from option A. So on the blue bars here to show the gradual reduction in direct payments. And if we add up all the net payments that we would get from the various actions we've seen in option A, the income that the farm receives is shown by the green bars there. So as a result of signing up to the actions under option A, the farm's going to receive £18,000 in year 1, 26,000 in year 2, and 26 in year 3. So again, we've looked at that over 3 years because some actions are done on an annual basis, some are a one-off cost incurred in the first year, but then you'd have to repeat the same cost again in second or the third year. So that's why we're showing the different differentiating costs over those 3 years. And on average, the farm's receiving typically £23,400 over the SFI 3-year agreement. What we can see is that as the direct payments are in decreasing, SFI is becoming a larger proportion of that extra income coming in, but by no means does it fill the gap left by direct payments. So before direct payments reductions set in, the farm is actually receiving about £105,000 in direct payments. Considerable gap there, as you can see, and it's just showing that farmers are going to need to look at other options to plug that shortfall. Next, we're going to look at how option A affects the farm's net profit, or the bottom line, total revenue minus the total cost. And to look at this, we've had to keep all the other variables on the farm the same, such as price and yields, etc. So we can just look at the effect of what the SFI is doing to the net profit level. And as you can see here, in the first year, the farm's net profit increased by 10%, 15% in the second year, and then 16% in year 3. I just want to show you now the effect that the SFI has on farms with different profit levels. So the blue bars here, we've got exactly the same, the gross profit level that we just saw before in the previous slide. And obviously this is based on the farm having a gross profit of £1,200 per hectare. The green bar now is if we assume that the farm had a higher gross profit value at about £1,700 per hectare. As you can see, that the SFI has a bigger effect in percentage terms on farms that have a lower gross profit levels. So that £23,000 income that was coming in from SFI option A is going to make a much bigger difference in percentage terms to a lower number, i.e. a low gross profit, than it's going to do to a higher gross profit. So we're going to have a bit more of an ambitious approach now, and option B contains all the actions in option A plus these 9 additional actions, and all of these actions are land requiring actions. And obviously if you look at the payment rates, the higher payment rates than we saw in option A, and I think this is why there was that concern about the SFI taking land away from food production, because at first glance they do look rather attractive. We take this unharvested cereal headland action, for example, that's a CS mid-tier action. You can see that the payment rate is over £1,000 per hectare. But if we remember that these are the payment rates, the published payment rates, they don't include the costs that are involved in actually carrying out these actions. And if you were to hazard a guess, how much of that £1,072 per hectare was actually you'll get from doing the action when you factor in the cost, you may be surprised to know that the net payment is actually, when I worked it out for the farm, was £90 per hectare. So that's a considerable difference, and it just goes to show that you can't take these published payment rates at face value. It's important to factor in the costs. So next we look at how this affects how much income you can get from option B, and you can see that the farm generates an extra between £28,000 and £41,000 of income over the 3 years as a result of doing option B. And again, you've got a lower payment in the first year because there are some establishment costs for some of the actions, but then in years 2 and 3, you're just maintaining those. For example, if you've got a flower-rich nectar margin, it's just a maintenance rather than establishment, so that's why the costs are lower. And therefore you get higher payment. If we look at in terms of what happens in net profit, we can see that in option B improves the farm's net profit by 15% in year 1, 23 to 25% in years 2 and 3. But when we did these land requiring actions for option B, we minimized the amount of land we took out of production on the 455 hectare farm by incorporating an area of unproductive land on the farm. So we assumed 22 hectares, which is about 5% of the farmland, was our unproductive land, and we used that to carry out most of the actions which are under option B and require land. So I'm just going to bring this up again. So that's the same slide that we just seen before, but I want to now compare it with what would happen if I had used my productive land on the farm. So here's option B on productive land, 15 to 25%, as we saw before. But if I reduced crop area, use some of crop area and used more of my productive land to carry out these option B actions, then the net profit doesn't increase by as much, only between 3 to 10%. And in the next graph, I'm just going to highlight again how using the farm's productive land for the SFI has an increasingly detrimental effect on the farm's net profit level. So we've got a change in net profit on your y-axis, and then how much proportion, the percentage of productive land entered on the x-axis here. This blue line here is just showing there what the effect's going to be. So if you've got no productive land, if you don't enter any productive land into the SFI, for example, in option B, the farm's net profit level will increase by an average of 22% over the 3 years of the SFI agreement. But as the proportion of productive land entered increases, the change in the farm's net profit level would decrease. And if you enter over 25% of your farm's productive land, the farm starts making a loss. And as we said, this is for a gross profit level of £1,200 per hectare. If we had a farm with a higher gross profit level, that decline would be steeper. So the percentage of productive land, as that increases, you get a bigger decline in your net profit change. And here, around 5% of productive land entered, you're actually, that's where you fall into the negative territory in terms of your net profit. And that's because the productive land is a bigger component of the farm's profitability when that gross profit level is £1,700 per hectare, or a higher profit level, rather than when it was at £1,200 per hectare. In both cases, the optimal change is when no productive land is used. And this again just highlights why it doesn't make economical sense for farmers to use their productive land for carrying out these more ambitious land requiring actions. And this was reflected in the first set of SFI uptake data, which was released in May. And we're looking at again at the land requiring actions there, which I listed on the slide there. And thus it showed the situation as of 1st of April 2024. More than half of the 13,400 farms that had enrolled in the SFI at that point, they didn't enter any of their farmland into these actions, and 81% entered less than 10% of their land. And from what we've seen, you would expect that to be the unproductive, the poorer areas of your farm. There have been, obviously, as you can see in the donut chart, there have been some cases of large proportions of farms being entered, but they are in the minority and likely to be landowners rather than farmers. The 25% cap, which limits how much land you can enter into these actions by up to 25%, was introduced on the 25th of March. So we can expect that if a similar set of data is released in the near future, we expect a further squeeze on that upper section, that the higher proportions of land entered at the top of the donut chart there. And also, all of the actions are listed here, all of them are capped apart from the buffer strips on arable land and on grassland. There's also some, for example, the unharvested cereal headland that's been capped as well at 25%. AHDB's planting and variety survey, which is based on data collected between 15th of April to the 14th of June, also showed a similar trend to these SFI DEFRA stats, i.e. the majority of farms had less than 10% of land entered into these land requiring actions. So we can take a look now at how the cropped area in England has changed over the past 15 years. And if you look at the left-hand axis there, we'll see that it's mostly been around the, if you look at the total crop area, it's mostly been about 4 million hectare mark. And then in 2020-23, it fell by about 4% to 3.8 million. And then 2023 reduced a further to around 3.5 million, another fall of 7%. Over the same period, the area under temporary grassland has increased by about 22%. And you can start on the right-hand axis. And the uncropped arable area between 2013 and 2023 has increased by around 18%. So this year we can see that we've got that spike there with uncropped arable land at 580,000 hectares, which is the highest since 2003. So what's this spike due to? Well, DEFRA published how this uncropped arable land was split between bare fallow and that used environmental schemes for the first time this year. And I'm just bring up the next chart, which is the same thing, but now look at the red line here. What we've done in this line is that this is only showing uncropped arable land which is used for environmental benefit. The red line here has now taken out any land which has been left as bare fallow. And it's not much surprise given this year due to the weather, because it's been much wetter than usual, much more difficult to get the crops into the ground. And so if we look here, just to compare, if you look here, that line goes up to just over 580 kilo hectares, and here when you take out bare fallow, it's only 305. So looking about 275,000 hectares is due to bare fallow. And it's better, so that bare fallow land has got potential to go into the SFI, and it may be tempting to enter land into the SFI if things don't go to plan on the weather front or from other problems. If you've got problems growing certain crops such as rapeseed, for example. But what we need to remember is that the SFI is a 3-year agreement, so it would effectively be locked in to the scheme for 3 years. And next, we're going to look at a scenario which shows the potential impact of this. So I'm going to look at a hypothetical situation now where the farm's rapeseed crop has not performed well. So we had a poor yield of 1.7 tonnes per hectare, and this would be the net profit in the blue if we had grown rapeseed. But if the farm had swapped rapeseed for an SFI legume fallow, it would have been £1,500 better off by making that decision. But if you remember, that's a 3-year agreement, so you'd have to keep that legume fallow for at least another 2 years. And let's say that in the second year, rapeseed prices, the rapeseed yield is a bit better, price is also higher, and there's more favourable conditions, so the yields also increase as well. How does that affect things if you had grown a legume fallow? The farmer's going to receive about £11,000 from the legume fallow, but if they had grown rapeseed instead, it would have made more money. So because having that legume fallow in there instead of rapeseed has now made a loss of £35,000 for the farm. Similarly, if in the third year we're assuming a rapeseed yield of about 3.2 hectares, a price around £400 per tonne. In this case, if the farm had opted for growing a legume fallow rather than rapeseed, it would be about £20,000 worse off. So it just highlights the risks involved in this approach. You might be £1,500 better off in the first year when you make that initial decision, but effectively lost over £55,000 over years 2 and 3. We can't really predict what the weather and the price are going to do. And generally speaking, and we've got analysis on the website to show this if you're interested, it only makes financial sense to replace rapeseed with SFI legume fallow if you're getting that persistent and consistent crop failure. So here I've just done the same thing again, but this time I've just looked at winter beans because they can be a bit problematic to grow as well. And what would happen if you replaced the beans with SFI legume fallow? So we've got similar scenarios as for rapeseed. In year 1, we've got low yield average price. Year 2, we've got average yield higher price in year 2 and average yield average price in year 3. So in the first year, the farm's around £4,000 better off with using the legume fallow rather than beans. But in years 2 and 3, over those 2 years, it's almost £34,000 worse off because it's grown the legume fallow compared with winter beans. So from what we've seen, I think it's fair to say that the SFI is not going to remove large swathes of land used to produce food. and we're just going to recap the evidence and reasoning behind this. Mainly because it's detrimental to a farm's net profit to use a productive crop area for SFI. It makes much more sense to use the poorer, unproductive areas of your farm, which may not be providing much return. But if you think about it, if you use SFI, potentially maybe these areas which are not giving you much return at the moment may provide more return in the future because you've replenished that land. So it's kind of thinking about how can you maximize every hectare on your farm. The uncropped arable area, arable land in England has averaged around 5 to 6% of the total croppable area over the past decade. And this is the land that we'd expect to be used for SFI, just as it has been for countryside stewardship and environmental stewardship, etc. Also, we expect that the land that's currently in the countryside stewardship or the sort of agri-environment schemes to be transferred into the SFI as those old agreements end. There's potential that between 1 and 2% of land that may come up of production due to the switching out problematic crops, such as we've seen. If you've really got that, persistent rapeseed crop that fails year in year out, it may be maybe a option to go into SFI. Or we might, and also in terms of the land increasing land, we might have further growth in applications, and there may be some short-term reactions into as well, but hopefully the latter will be a minimal, because we've seen that it's a risky strategy to swap crops for SFI actions unless you're able to predict yields or prices in the future. Looking forward, there are some important unknowns, both good and bad. So a potential good unknown is just kind of like highlighted a bit earlier, was whether the SFI improves the condition of the land and we see an uplift in yields, and that could have a positive effect on food production. But a potential bad unknown is that some actions could lead to a higher weed burden. And the AHDB research team is looking into this, so we get more details of that in the new year. But while the SFI is unlikely to be a threat to food production, are there much more bigger threats on the horizon? And first, we're going to look at some of these that have been making the headlines over the past week. So in last week's budget, it was announced that there will be a change in agricultural property relief and business property relief from the 6th of April 2026, an effective 20% inheritance tax on agricultural assets above £1 million. Now, this has sparked considerable debate, and some of the issues that have been brought up are I've just included here. So, for example, how much will it cost to pay that tax? Would you have to sell land to pay that tax? And does that mean, losing land, losing your farm in the future, if you're to pass on to next generations in the future? Will it accelerate the succession process? Will it make it more difficult for banks to lend, or will it put off investment for the future? Will it restrict the kind of amount of land that's available for tenant farmers? And this is the kind of main objective behind why this is being done. Will it reduce demand for agricultural land from institutional investors? Now, the direct, indirect, and unintended consequences of these are complex. We need more time to delve into this and look at exactly what this involves, how different allowances could add up, and how many farms could be affected. But we are looking to this, and we'll be publishing something very shortly on the web, soon on the website. Another announcement that was made was the cut to direct payments for farms who would, especially those historically received the highest payments. It's an acceleration of that cut. So we already know they're being reduced, but this is like a steeper cut in 2025. And for farm businesses that had budgeted cash from, the original estimated payment, that could cause some cash flow issues. Also, it could particularly hit farmers who are coming to the end of one scheme but unable to enter one of the new schemes. DEFRA have indicated that there could be extensions offered to those in existing agreements in high-level stewardship or other higher tier agreements, but we're still awaiting further clarity on this. And this does bring back the concern for, which was there at the initial when these schemes were announced, was that would the rate of decline of direct payments be faster than farmers obtaining income from new schemes that are being developed? The other main point from the budget was that the 2025-26 funding pot has been kept at £2.4 billion. The graph here shows how the ag budget has been allocated or used over the previous 5 years. So in the blue, we can see how direct payments, how much has been going into direct payments. In the green there, how much is going to agri-environment schemes. And then the yellow line at the top, yellow block at the top is in terms of productivity grants, etc. And so this And we can see that this underspend within these middle 3 years here, this was causing the concern that, before this budget was announced, how much, would we lose that money, or, would it be reduced, and would that money be lost? But the forecast for 24-25 is that spending will be higher than the other 3 years, around £2.9 billion. So overall, that 12 billion budget, which is over those 5 years, would be used up. Increasingly, more of the budget is going to agri-environmental schemes, and that's the reason why in 2025 there's going to be a steeper cut to direct payments, is to provide more money for ELMS. So £1.8 billion of that 2.4 billion total funding part will be allocated to ELMS. And you can see on the graph that's going to be probably the highest amount allocated so far. But the real value of this funding has been eroded by inflation. So analysis that we carried out over the summer showed that farm input costs increased by 44% overall between December 2019 and May 2024. And if we take into account the latest inflation forecast by the Office of Budget Responsibility, we're potentially looking at the current value of the ag budget shrinking by around 52% to a real inflation-adjusted value of just under £1 billion by the end of the ag transition period in 2027. And also it's worth remembering that this initially this £2.4 billion budget was based on how much payments we were receiving from the old EU system, rather than what was needed to meet the objectives and aims of the farming countryside programme. But I think there's also much more serious and longer term challenges ahead as well. And depletion of our natural capital is high on the list. So Natural England published a report assessing the state of England's natural capital earlier this year. And key findings were that all of our ecosystems and all the benefits that they provide are at high or medium risk. And because of this degradation to ecosystem, their resilience is much less than it was before. It's certainly declined. So I've got a few examples here. Erosion. So soil erosion, the cost of soil erosion in England and Wales costs about £1.2 billion per year. And put that into perspective, that's half of the agricultural budget. 71% of the land at risk of flooding is agricultural land. And we've seen that firsthand this year with many fields underwater. And if we put agriculture to the side, we've seen more of an stark example in Spain with the loss of human life. Pollination is an example that given in the report as a medium risk, and obviously pollination is extremely significant for crops. Benefits of pollination estimated to the industry are estimated at £500 million. But the UK's flying insects have declined by 60% in the past 20 years. All of this has implications for our food security. And if we carry on along this trajectory, i.e. continuing to deplete our natural resources, not only does that put farming at risk, but it also puts the economy at risk. A report by the Green Finance Institute shows that if we carry on, it includes modelling results to show that the GDP, our UK GDP, could be 12% lower by the 2030s than would otherwise be the case if we didn't deplete our natural environment. And just to put that into perspective, the financial crisis in 2008 wiped 5% off our GDP, and COVID wiped 11% off our GDP. So this is a higher estimate than that. A report by the RSPB National Trust and the Wildlife Trust estimates that we need to invest around £2.6 to £3.1 billion in nature-friendly farming and nature-based solutions in England. And again, you can see there that's bigger than the ag budget. So we've got a classic problem of a finite resource, be it land, be it money, the budget, but a lot of different demands. And what we need is we need a targeted approach to make the best use of the land with the money that's available. So it kind of leads to the question, are we missing a land use framework? Are we missing a land use framework? Because some estimates show that we only need between 7 to 10% of the farm is needed to target nature. So if done well, we could use less land and spare more for other demands. And also, do we need a framework to see what the government are trying to achieve and what direction we're heading? Because then that gives you as farmers some certainties to invest in the future. You know where and what to invest in, and that's important because investment today will drive your income tomorrow. We need farmers to grow food and extend your role as custodians of the environment, but we know that farmers are facing multiple challenges, including losing your income, as we've just seen with the direct payments, extreme weather as well. So while there's been questions around whether the SFI was going to take land away from food production and thereby threatening food security, perhaps the more important question to ask is, what does it mean for our food security if our farmers are going out of business? Thank you for listening.
Thank you, Amandeep, for taking us through all of that fantastic information there with regards to SFI and the budget. We have a little bit of time for questions, and a few have come through. If there's any burning questions that anyone has, feel free to put them in. So if I could invite Helen and Olivia and Amandeep to join me again. We've got 2 or 3 questions which have come through. So the first up, I think it's probably a bit of a joint question, this, for Olivia and Helen, is around milling wheat premiums, and if we expect to see milling wheat premiums getting squeezed because of imports, and there's a bit of a differential between our prices and the German market. So do we expect that milling wheat premiums are going to be squeezed because of a volume of imports that we're seeing? I guess that's again in reflection of the smaller crop that we have. So I don't know, Olivia, is that something you want to pick up from a domestic position?
Yeah, I can start off. So yeah, I think as I sort of showed on that chart when I was talking about quality, we've obviously seen them squeezed over the last few months because of that imported wheat being slightly more competitive. I think it's also slightly to do with the fact that earlier on in the season we were probably a bit more pessimistic about what milling crop we were going to have for harvest 24 as well. And I think we saw premiums really, really high, sort of in the spring, for example, and we saw them pull back slightly. I think due to those imports, but also combined with the fact that the domestic crop maybe wasn't as small as was feared earlier in the season. And so again, that contributed to a bit of that pressure. But yeah, looking forward, I think that imported price will continue to sort of drive that premium. It'll obviously depend to an extent whereabouts you are in the country and sort of the cost of delivery within the domestic market as well. And also looking even further ahead at premiums later on in the season, they'll probably fluctuate a bit in terms of how much we manage to get drilled for harvest 25 as well, but that's looking a bit longer term. Hopefully that answers the question.
Great, thank you, Olivia. And Helen, if I can come to you with a question now as well. There's a question that's come through around the demand in global markets, and obviously there's a minimum base demand, as described in the question, which the world would need in any event. And is there any information available, either present or historic, so that we can compare the current year's demand with what normally happens? I suppose it's looking at it from a broad kind of view of demand, of saying how do we compare where we currently are to where we've been previously.
So yeah, we can look back and we can use, I was having a quick flick just now, and yeah, I would probably take the sort of COVID years as like a lower level of a minimum, not minimum, but a recent minimum, if you like, because the demand did drop into that season with the reducing road transport fuel requirements, needs for then biofuels by default, and also less demand for sort of on trade as well. So beer consumed at venues rather than at home. So that would give us one view. That I think the challenge of trying to look at a demand side is just how long it takes data to get through from a whole world perspective. So we tend to monitor global exporters, particularly the top exporters, the sort of Russia, US, EU, Canada, as a proxy for global demand to give us a feel of how things are progressing in the short term. Just because if we're waiting for statistics on how much wheat has been used to produce bread in, say, Egypt, Argentina, all across the world, it's going to take a long time to collate that sort of data. So you do still see revisions to retrospectively to historical figures, as that sort of information comes forward, but the amount of time it takes to collate that from across the world, we use that sort of export pace from major exporters as a proxy in the meantime.
Great, thank you, Helen. I'm conscious of time, and we're due to wrap up at 12, but there's a couple of questions that have come through on the topics that you covered, Amandeep, which I think probably would be relevant. The first one is looking at BPS payments and how de-linked payments have changed for next year as well as an outcome of the budget of last week, which would show that direct payments are being far less of overall farm profit. So I suppose the overall question is, in terms of the direct payments and de-linked payments and the reduction, I suppose what's the impact on farm incomes and farm profit levels from the changes that we're seeing?
It's kind of to what I alluded to in the presentation. So I think before we were looking at we knew there were going to be de-linked payments coming in from 2024, so that would have been factored in. But then this sort of the steepness of the 2025 reduction is a lot more steep than others would have thought of. So if we take a look at the virtual farm, for example, I think originally I was probably still be getting, the farm should maybe have been getting between, I don't know, £20,000, £30,000 for 2025. And now having these reductions in place, it's just getting between about £7,200. So that's quite a steep fall. And it's just about, for farmers who obviously, you've got to think ahead. For farmers who had factored in that they were going to get that income for 2025, to now see that it's been cut quite considerably, it's going to impact cash flow, and there's going to it's going to lead to tightness in that kind of respect. So yeah, not much notice on that front. So that's why the challenges ahead, I think, is seeing how you're going to adjust your business model if you were relying on that cash in the first place.
Great, thanks, Amandeep. And as I suppose a final question to you regarding SFI again, we've had a question that's come through that's asking, what is the current maximum percentage of area that can be entered into SFI?
So it depends on, so for the 25% cap that I kind of showed in my presentation, is that there's various actions. So I think there's about so it'll be half a dozen. So we had the half a dozen that were listed before in the slides, but there's probably a total of at least 10 that any combination of those, you can't enter more than 25%. So that's kind of like limiting basically how much farm in your land requiring actually can't enter more than 25% of your farm into these actions. It doesn't mean even if you had one of them, if you have have bits of all of 20 or 12 of them, for example, you can't have more than 25%. So that's like a firm sort of limit there. But like I said, you'd have to wonder, why would you want to enter more of your farm into in the first place? So we saw what happens with this graph. The more you enter in that's productive land, you're just going to lose your net profit. So it's kind of finding the balance there. You'd only use your unproductive areas in the first place anyway. And I'm not sure if many farms would have more than 25% of the areas of the farm as unproductive in the first place.
Great, thank you. So kind of both restricted by what the cap is, but also, as you say, what the level is, productive and unproductive. We're running out of time, so we've only got a minute left. So I'd like to wrap up by just saying thank you to our three presenters, to Helen, Olivia and Amandeep, for running all through that information. There's a few questions that have come in that we've missed out on, but we will make a note of those and then reply individually to those in due course as well. So don't worry, your questions will be answered to and will be responded to. And thank you for all the notes and the feedback as well that have come through. And just a reminder, there is a short feedback survey at the end of this seminar, so please do fill that in so we can improve and adapt what we do for the future. Apologies for the technical issues that we had at the start. It's always sod's law that everything runs perfectly when you do the run through, and as soon as it comes to the real thing, the system throws a wobbly. It's what's sent to test us, but we managed to get through it. So thank you for bearing with us, and thank you for staying with us. So we've reached the end of our time slot, so I'd like to wish you all a very good rest of your day, and all of the information that we had available here will be made available on our website as well as the recording. So we'll bring the webinar to a close there. Have a good rest of your day, and thank you.